everybody. Thank you so much for joining. I was having some technical difficulties, but we should be good to go. First thing I am going to do actually is share this video to my page, and I hope you will do the same thing. I'm going to share it a couple of different times. So tonight we are going to talk about home ownership and the all of the different things that come with being a homeowner or starting your journey of becoming a homeowner. And the reason why I am doing this live tonight is because there are so many people out there who truly want to become a homeowner and don't know where to start. I have 8 years of experience of helping people become homeowners. I have been a homeowner twice, so I've been in the market twice. I owned 2 homes by the time I was 30, so I'm really excited to bring to you some things that will help you in your journey. I'll start off by telling you a little bit more about me. I'm Yolanda Makumbe. I am the owner and founder of YGM Consulting, and I am really excited to bring this to you. I had to come live from my actual Facebook page because for whatever reason it wasn't letting me go live in my business page. So by the way, please check out my Facebook page and go like my business page, which is Yolanda G. Makumbe as well, so that we can connect. So tonight, again, we're going to talk about the importance of what becoming a homeowner looks like. Okay, so I'm going to start by saying that right now in the market, it is quite vicious and there are more buyers in the market than there are sellers. And so it is causing a major price increase in home value, or well, homes and home values, which is great for homeowners, but not so great for people who are trying to buy right now. Some of the things that are going on in this market are appraisals being waived, where it used to be if an appraisal didn't appraise for the purchase price, that the owner and the seller had to go back and renegotiate the price, but now buyers are having to come up with the difference if they went under contract for a higher price. If you're just now joining, please say hello, and if you have any questions, please do not hesitate to ask, because this is also a Q&A. I want to make sure that you are getting your questions answered in this live. So right now, like I said, there's a major shortage in homes. I know we are here in North Carolina, and a lot of people are struggling to get a home right now because there's a shortage of inventory, and then people are being priced out of the market. And what that means is what you may have qualified for a year ago, there are no homes in that price range, and so you're having trouble finding a home within that price range. Your income may not have changed, but the price of houses has increased, so you might not be able to get the same amount of house that you would have been able to get previously. So to start your home ownership journey, you want to start by evaluating your credit. Your credit is going to be one of the major things that gives you a green light on whether or not you're even in the process. You can even start your process. And when you're looking at your credit, some of the things to look out for are having collection items. Collections means that you had an account with a company and you may not have paid them, and so that account went to a collection agency, so it shows up twice on your credit report. If it's unpaid, then it's going to show up negatively on your credit report, and that is one of the things that can keep you from getting a home. Another thing is delinquency. So of course we all went through the pandemic last year. Some people may have lost income, some people may have lost jobs, some people may have had to stay home with their kids for whatever reason that your income may have shortened and prevented you from being able to purchase, to pay your bills, your credit obligations. Then any type of delinquencies that show up on your credit report are going to also hinder you. So when you are starting your journey to a home ownership, you want to make sure that you keep your credit obligations in good standing. That means making your payments on time, making more than a minimum payment if you can, and also making sure that you are keeping that debt ratio down. So that looks like keeping your credit card limits. If you have credit cards, keeping those limits, keeping the debt usage 30% or less. 30% or less. So if you have a credit card that is $1,000, the limit is $1,000, you'll want to keep your limit or whatever charges or whatever balance that carries over every month $300 or less. Okay, so that's one of the really big things that your credit score is made up of. Also, the length of history that you have with creditors. So, depending on your age, you may have a longer length of history with creditors. That can be a good or a bad thing. If your longest account is a negative account, then that's going to negatively impact you in the long run when you're trying to get a home. So you want to make sure that you don't open up any new accounts if you're in the process of trying to get a mortgage, because that does shorten the amount of history that the average age of the accounts that you have, and that shows up also negatively. It negatively impacts your credit score. Whenever you're in the process of starting your journey, it is really not wise to open up any type of new credit accounts, period, because that is creating more bills. So that means don't go out and get a new car. Don't go out and buy new furniture on credit. Don't go out and get a personal loan unless it's a debt consolidation, which we'll talk about in a second. But don't go out and get more credit thinking that that's going to help you. In the long run, oftentimes, especially, depending on your situation, it can really negatively impact your ability to be able to pay in the long run. So for instance, if you run into an emergency, you have to go get a loan, and you already are strapped for cash every month, then you're going to, strap yourself up even more by having a monthly obligation that you now have to pay, which will decrease the amount that you can actually afford in a home. So, no new inquiries, no new credit accounts. Those are going to be the first things that you want to make sure that you're doing when you are starting your process to homeownership, right? The second thing that you'll want to do is start saving. And that's really like the first thing as well. Saving and credit, they go hand in hand, because yes, there are some programs out there that are 100% financing, and that is great. But if you may or may not qualify for those programs, so if you have certain credit unions, they might have 100% financing. You might be able to find some down payment assistance through the city that you live in or the state that you live in. There's some down payment assistance. But there are many different things that come with having to purchase a home. When you're going into the home ownership process, there are a couple things that you have to do. There's called due diligence money, which is basically saying, hey, I'm giving you this money. It is non-refundable, and this is showing that I'm serious about going into this contract with you, and I'm going to do whatever I can to make sure that I don't back out. That can run you from, $250, which is probably not happening in this market right now, upwards to, some few thousands of dollars and maybe even more. And that money is non-refundable. So when you're in the market to get a home, you want to make sure that you have money that you can pretty much stand to lose, I'll say. But if with the due diligence money, if you do put it down, that does go towards the purchase of the home when you go under contract. Then you have your earnest money, which is refundable, and that is also applied to your purchase price when you go under contract. That money is refundable, but that money can also start to add up. That is for the contract things. Then when you're trying to get the mortgage through the lender, you may have different fees that you have to pay: a credit reporting fee, application fee, appraisal. You definitely have to pay for an appraisal. Some types of inspections. Sometimes you have to pay for an inspection. It's always wise to get an inspection, but it's something that you would have to pay for. A pest inspection. And also you have to think about moving costs, because typically you're going to be living somewhere when you are in the process of looking for a home. So you have to think about the moving costs that are associated with having to move. So you have to think about saving now before you start your process, because you don't want to be strapping yourself and really going into this process being broke before you can even start. A lot of people will think, okay, I can just use my money for my paycheck to pay for these things. And yes, you can, but then that's taking money away from you being able to put up for your emergency fund or your savings later that you would need to take care of things in the house, which we'll talk about a little bit later. The third thing is to have a plan. So you can decide to wake up today and say, hey, I want to get a house. You can do that. You can absolutely do that. But 9 times out of 10, it's not going to happen, because if you have not done your due diligence up front, then when you go to a lender to try to get approved for a mortgage and you haven't addressed your credit, you haven't saved anything, you are just waking up and saying, okay, I just want to go to the bank to see how much I'm going to get approved for, you're going to walk away disappointed. And that may not be the case for everybody, but it can cause you to be frustrated, and it would really suck to start your journey in that way, because of the fact that you are having to pretty much like start from square one, when you really could start from square five if you were able to show up at the lender with your things in order, with that savings account already established. And if you're thinking about, and this is really just dependent upon what the amount of home that you're getting, but some programs out there, I talked about the 100% programs, but there are some programs out there that you can do a small down payment, so 3.5% down payment. That's FHA, which is federal, and most lenders will have an FHA option. If you are military, you can do a VA loan, which is a really good option as well. And so you have different options for being able to do a down payment, or maybe not do a down payment. But again, you just want to make sure that you are putting yourself in the position where you can go through the process without having your hands tied to be able to do certain things when it comes to purchasing a home. Also think about, when you purchase a home, you'll want to furnish it, you'll want to maybe paint the walls, you'll want to do certain things. And if you haven't saved any money for that, then you might find yourself frustrated for the moment that you even get into the house. I know several people who have bought their homes, and they get really frustrated from the beginning because their cash is tied up at that point. Somebody asked, what's the ideal amount to have saved up, rough estimate? I would say to start your journey, and again, this is really dependent upon what price range you're in, but I would say a good number would be $4,000 to $5,000. That would cover the fees that I discussed, that will cover the lender fees, that will also help make sure that you have money in the bank for moving expenses, and still have a nest egg for when you move into your home. That's just on the low end. And again, in this market, you need a little bit more than that, but on the low end, $5,000 is a really good place to start for start your home ownership process. Thank you, Maggie, for asking that. So with loans, there are so many different loans out there for you to take advantage of. Like I mentioned, FHA. FHA is conventional. You can do 3.5% down payment. You can do whatever lender that you go with, they may have different programs, but most lenders are going to have a FHA option. You also may be able to do a USDA loan, which is if you live in a rural area, then you will be able to qualify for what's called a USDA loan, and that is to promote home ownership in rural areas. They typically have low or no down payment. The rate on the mortgage is a fixed rate, which is going to be really good for a first-time home buyer, especially if your income is a little tight, because you don't have to worry about your mortgage changing over time, and your interest rate hiking up or changing, going up or down with an adjustable rate mortgage. So with a fixed rate, it just gives you the great opportunity to be able to just say, hey, I know what my mortgage payment is going to be. It may fluctuate due to property taxes and insurance, but for the most part, I know what my principal and my interest are going to be. What your mortgage is made up of is your principal, interest, taxes, and insurance. Property taxes, which you pay to the county and or the city that you live in, and sometimes you're paying both of them. And then the homeowner's insurance is, if you use Progressive, AAA, whoever has homeowners insurance, you just get, that's who you get your homeowners insurance through. But usually your lender, you pay into what's called an escrow account, and your lender will just pay those things out each year if you have a mortgage on the home. You also may run into what's called homeowners association dues. Those are paid separate from your mortgage. So you pay the lender your mortgage payment, and then you pay homeowners association dues to your homeowners association if you have one. So that is going to be in subdivisions that are newer. So they can be older as well, but they'll have what's called homeowners association dues. Those regulate the different things in your area, in your neighborhood, that you can and cannot do. It keeps your neighborhood looking good so that your property values don't go down over time. They regulate your grass. If you live in a townhome community, they actually cut your grass. They make sure your roof is good. They make sure your exterior is good. So homeowners associations get a bad rap, but they really can be a really good protector of your property value in the long term. I know when I had my townhouse in Durham, our homeowners association, they were responsible for a pool that we had that was never in use. It was always getting fixed. And then they were responsible for our roof and our exterior. So actually, point in why you need to have money saved up is because when I purchased my first townhome in Durham, everything looked fine. We got inspections done. We got the appraisal done. There was nothing, okay? Nothing. Well, the day I moved in and after I closed, when we were moving in, it was raining. And I walk into the house, unlock the door. I was so excited. Walk in, and there is water running down from the ceiling to the fireplace, okay? And it is like my first time buying home, and so I'm frustrated. Like, what? So we had this back and forth with the HOA because there was an issue with whoever they contracted to do the work, and so we were able to get it fixed. I didn't have to pay for that, but they actually tried to make us pay for that, even though they had hired someone to do shoddy work. So yeah, if we had to worry about that, that would have been money that would have come out of our pockets. Another thing that happened within my first year of home ownership was the HVAC system had to be replaced, which is the HVAC is like the air conditioning unit. That had to be replaced because it was old. And that was about a good $3,500 within my first year of being a homeowner. Now, let me tell y'all, home, and I got comfortable. I said, cool, this mortgage is really low. My income is going up. Let me go get this new car, which I did need a new car. And I did get a reasonable payment. But the week after, y'all, I'm talking about the week after the HVAC went out and I had to use that money, use all that money to get the HVAC fit. Well, actually, we just had to get it replaced. So those are things when you become a homeowner that you have to actually plan for. You can have what's called home warranties on your on your home, and those are really good to have. They're really low cost, and they cover some of those things like the random breakage of your HVAC. If your refrigerator breaks down, if your microwave, dishwasher, what's that thing that garbage disposal, if those things break, any of your electronics in your house break down, then a home warranty will help pay for that. It's very important that you do your research on home warranty companies, though, because sometimes they give you a really hard time. And I mean, if they're having to pass out money, they may give you a hard time. So just make sure when you looking at home warranty companies that you are make sure that they have a good reputation. Also, when you are purchase a home, on your way to purchasing a home, you can sometimes negotiate a home warranty within your contract for the seller to pay for, so that then you have at least a year of a home warranty where if something breaks down, you're good to go. Um, Somebody said that, yeah, North Carolina has less than 1,700 homes available, and the prices are inflated. The the prices are really inflated badly. I mean, really bad. I've heard that, especially like in the Raleigh area, Apple is moving to Raleigh, and so I already know that Durham was getting high. I was able to sell for a really big profit my first townhome, which I'm mad that I sold when I did, but I'm glad that I sold when I did, because I sold in 2018, and yeah, the market has completely changed in that 919 area. Um, I've heard that people have to basically ask, put $50,000 in additional what's called due diligence money, and then they also have to do like over, what do you call it, over asking price. So I actually recently heard that somebody had to do $50,000 in due diligence money. Again, due diligence is not money that you get back, and then $60,000 over asking price, y'all. As you know, a lot of us do not have that money on hand. So not only are we faced with a low inventory right now, a lot of people don't have that type of money to even be able to get into the market if that's how they're playing this game right now. So yeah. The another thing that's going on in the market right now is there's a shortage, or there's a price hike in lumber, which you need to build homes. So, it's just like a really bad situation to be in as somebody who is in the market. It is really crazy. It is very important when you're on this journey that you do your research. So there's a website, it's called bankrate.com, bankrate.com, which is a really good resource for you to search interest rates. Interest rates, they fluctuate very, very often, and you'll want to be able to, make sure that you do your research on which lenders have the lowest interest rate. Somebody just asked, what about building? So this is what I know, as of last couple weeks. If you're looking to build, that's really good. They're also asking for a good chunks of change to get started. So I recently heard from somebody who was in the process of getting their home built that they went under contract with a builder, and that builder asked for $14,000 up front, not as due diligence money, not as earnest money, but they asked for $14,000 deposit to even get started on building the home, which won't be done until sometime this time next year. So if you're looking to build, you still have to have money ready to go, even more money, because of the fact that, like I said, you want to be able to put yourself in a position where if these builders are asking for that money up front, you're able to do it. And if you have your own land, then you just have to find a individual builder. Like, there are a lot of builders who will actually, craft you a home, which is great. But again, everybody's fighting for lumber right now. So you will potentially have delays, and there are long waiting lists for new builds, because again, there are so many buyers in the market and there are not a lot of homes in the market. So now is really the time for you to just get ready and get prepared, so when the opportunity does present itself, you can make a move. If you start your process right now, I can pretty much guarantee you that you're going to be frustrated and it's going to irritate you. I can guarantee you that's what's going to happen. So this is really for you to get in position yourself to be able to actually buy your home, when the opportunity comes. Someone asked, do you have to file your taxes for the year before applying with the mortgage company? It depends on the mortgage company. With COVID happening, I'm pretty sure, mortgage companies have come up with something, right, to be able to mitigate all of the changes that we've experienced in the last year, but I would recommend filing your taxes and keeping your taxes current. Um, for reasons such as the IRS can come and put a lien on, they can, basically the IRS can put a tax lien on you and it can go on your credit report. And I've known that to be an issue with some people as well. With some lenders, they do use that against you. So you'll want to make sure that your taxes are up to date. Um, I'm glad that somebody asked about fabricated homes. If you're able to find, the land for the fabricated home and be able to put a home on some land, that really would be, I mean, that there's nothing wrong with that. I'm pretty sure there are many different companies out there. I know Clayton Homes, Oakwood, they have like modular homes. You can definitely look at that as an option. I know all it is just it's not built brick by brick or stick by stick. They're pre-made pieces put together, and you can get your home done quicker than waiting. Well, there's still some part of it that lumber is involved in, but you can definitely get a home, like a prefabricated home or fabricated home that you can live in, and that can serve as your forever home. You can have a low payment associated with it, and there's nothing wrong with that. Nothing wrong with that. So doing your research is going to be really, really, really great for you. There are a lot of different websites out there that can help you with figuring out what type of mortgage will be good for you. So if you are a W-2 employee, you just need to know that there are programs out there for you. If you are a 1099 or self-employed person, there are programs out there for you as well. The thing about being 1099 and self-employed is that your income looks different. And so you'll want to make sure that you are reporting your income as accurately as possible, because all they use is your tax returns or your bank statements. And so if there's any type of discrepancy there, then they're going to pull your funding. Which brings me to pre-qualified, pre-approved, and approved. When you are looking at getting into the market to start your homeowner process and talking to lenders, y'all, okay, there are a lot of different terms out there. Some of these terms mean that you can go shopping and you're good to go. Some of these terms mean that they've done some preliminary work, but not all the work they need to do, so your funding could fall through. And so you'll want to make sure that you're asking the question, am I good to go shopping? And what exactly will you need for this mortgage to go through? If you don't ask those questions, y'all, you're setting yourself up for a stressful situation. Underwriting it can be a different department for some lenders. And if you have to go through underwriting, if you're dealing with a loan officer, that loan officer may not understand the regulations and everything that goes into completing a file and having a file underwritten. So you'll want to make sure that you ask the right questions. So there's a term, it's called getting pre-qualified. And being pre-qualified, it can mean being pre-approved, but you want to make sure that you ask, because it's just like when you get a credit card in the mail that says you've been pre-qualified. What do you have to do? You still have to go there and get approved, right? So when you're pre-qualified, there's a whole process for you to actually get approved that may not be the same thing, and may not require the same things as being pre-qualified. It will require more. So you might be able to get pre-qualified and have $1,000 in the bank, but when underwriting gets it, they want to see $5,000 in the bank. So you want to make sure that you're getting very clear terms and clear understanding of what the lender is asking for, because otherwise you will find yourself frustrated. And I'll tell you about my second home. So when we got ready to buy our second home, we were looking, and we ended up finding this great home that a lender had pulled out of, and so a couple lost this home that they had built. So it went into inventory because they couldn't find a lender, in time to actually close. So the home was built and it went back into the inventory, and that's how we ended up with our second home. And it was a really unfortunate situation for them. It worked out for us, but that is really a cautionary tale to tell you that, you can go into building a new home, but sometimes it doesn't work out. So you want to make sure that the terms are really, really, really clear. Okay. There are programs all around NACA, NACA, that you can go through if you're a first time home buyer, or even if you're not. But there are income restrictions. If you have well, just go check it out. NACA workshops are really, really good. They walk you through the process, and but they also take a really long time. But they do get you in the process to be able to purchase a home, which is really good. But they can take a little while because they have a lot of people that they service. When you're thinking about doing down payment assistance programs, they're really good, but sometimes they can have what's called like invisible liens that you are signing off of and you don't even realize it. So with some programs, you can say they give you $15,000. Right? And it's supposed to be like down payment assistance, but what they really do is attach a lien onto the house for $15,000. So say you buy a home for $200,000 and you get $15,000 in down payment assistance. There's a lien on your home with the mortgage company for $200,000, and then there's another lien on your home for $15,000. Right? So there are two liens that you go into with some of these down payment programs. Two liens. Say you decide that you want to try to go sell that house, and the process, you want to go sell that house, but your house hasn't appreciated in value. So you bought the house at $200,000, but your home only appraises for $207,000. You have a lien total of $215,000. So you're kind of stuck, right? So if you're going to do down payment assistance programs, you'll want to make sure that you ask questions about, am I going to have a second lien on this property? Because people don't know when they're signing things. And unfortunately, if they try to sell, they find their hands tied where they can't sell because they have a lien, and the lien is making the payoff basically greater than what the house is worth. So it's kind of like you going into a home upside down. Somebody asked, what do you need for the State Employees Credit Union? So I used to work for the State Employees Credit Union. I no longer work for the State Employees Credit Union. So I would recommend that if you want to go through the State Employees Credit Union, which I think is a really good institution for you to get a mortgage at for many different reasons, I would recommend that you talk to someone in your area, especially if you're in North Carolina. There's a credit union in every single county, at least, and it's 100 counties, but there's a credit union in every single county. So I would recommend that you talk to someone who is in your local area, because unfortunately locality matters, and that's as far as I'm going to leave it. How long does the money you save for deposit have to sit in an account for income validity? They usually, I think they ask for 90 days worth of statements, I want to say, but you'll want to check the lender because that can also change. I know when COVID hit, that changed for a lot of lenders because people were losing jobs left and right, so they started to change the income requirements and income validity. But I think that they asked for 90 days, but I would double check just to be sure because it can fluctuate depending on the lender. These are some really good questions. I'm so glad y'all are asking these great questions. So I don't know if this is going to be the last thing, but I will say that when you're in the home buying process, temper your expectations and understand that it is a process. And so it's not for the faint at heart. I mean, it's really not. You can really find yourself somewhere in a corner crying and frustrated. I mean, it can be stressful at times, but make sure that you have a very good realtor who will be patient with you, who will answer your 50 million questions, who will, assure you of you're doing the right thing, or who will tell you up front, maybe this is not the time for you to buy a house. Like, let the realtor, the person that you hire for you, make sure that they have your best interest at heart, because if not, they're going to make it even worse, y'all. um, I had a really, really amazing shout out to Angie. She, amazing realtor, in buying and selling that first home. As a first time homeowner, I was 24, 25, somewhere around there. Hadn't been introduced to the process, so I was extremely scared and asked her a million questions per day. And we went through this process for about a month and a half. So a million questions a day is a lot of questions, but if she happened to come up here and see this, she will tell you that she is an amazing first-time home buyer and really just an amazing agent in general. And that's the type of person you want to have in your corner when you decide to buy a home, because what you really, it's a stressful process. I'm not gonna front, like, it's a really stressful process, but you want to make sure that you have that support in hand, so that when things do come up, they can guide you through, they can coach you through, and that they really are, your backbone throughout the process. And also because they're working for you. You don't have to pay your agent, but the sellers pay your agent, which is a really good thing, especially if you're a first-time home buyer. But your agent is working for you. And so if you have a lot of questions, you'll want them to be resourceful. You'll want them to be willing to find answers for you, even if they don't know, and be willing to say, I don't know, but I'll find an answer, versus telling you incorrect information just so it takes the pressure off of them, because there are some who do that. But in tempering your expectations, you want to think about your debt to income ratio, and can your income support the amount of home that you really want? A lot of people don't understand that. So if you make $1,500 per paycheck, that's $3,000 a month, then it's not feasible for you to have a mortgage that's $2,500 a month. It's just not feasible, because that you're going to be house poor. I mean, simple as that. You're going to be house poor. So you'll want to make sure that you are being realistic with what you want. And that doesn't mean that you can't have your dream home. That means maybe you become a homeowner now and keep that home for 5 to 7 years, and then save up and, have those good money habits, find more income so that you can get to your dream home, whatever that home is. But understand, when you do start your homeowner process, you don't have to start out with your dream home in mind. You can totally become a homeowner, get something that's income generating, get something that's going to appreciate in value, and that way you will, be able to reap some of the benefits of being a homeowner in the long run, versus trying to get that dream home right now and getting frustrated again with the process, and then giving up before you even get started real good. But being house poor, you don't, if you have a big pretty house, that's great, but nobody wants to sit in the house and look at four walls all the time. That's not what life is all about. So you don't want to be hand to mouth when you purchase your home. A lot of lenders, and I won't say all of them, but they'll try to keep your mortgage payment somewhere but with 30% of your income. 25 is the preferable number, and that's what I would recommend, keeping it towards 2025, just in case something happens. But a lot of lenders will want to keep that low because it reduces their risk. And because they're taking on a risk when they write a mortgage to you, because you could default, and that's anybody, job loss, life, it can happen to anybody. So they just want to make sure that when they're taking on that risk, that they're taking on a good risk. Which, in talking about risk, everybody remember 2007, 2008. It was a mess, y'all. It was a mess. But a lot of those companies are now having to pay back money to people who were borrowers for doing predatory things. So predatory things look like, hiking up interest rates, not offering you mortgage assistance when you need it, not being forthcoming with all of the terms, those types of things. So you want to make sure that you educate yourself about what is going on when you actually purchase a home. And there are so many different regulations that I am appreciative of when it comes to being a homeowner, because it protects home, like regulations are written to protect homeowners from lenders, including, if you are late on the payment, they can't just knock on your door and take your house in a day. They cannot do that. There's a whole drawn out process that they have to go through to be able to, foreclose on your home. They have to offer you assistance. There are a lot of different things that homeowners have the opportunity to make sure that they are able to take advantage of, versus if you're renting. But there's nothing wrong with renting. It's just that homeowners do have more protections in place than if you were renting. Anybody else have any questions? Because I could go on and on, but I don't want to do like an information dump on y'all. There are a lot of programs out there. Like I said, there's NACA, there's the Federal Home Loan Association, Federal Bank Home Loan Association of Atlanta. They do down payment assistance. I want to say that NACA actually just today or yesterday released that they have a whole bunch of money available for people to do home ownership. So that is, the process sucks, but that would be something I would recommend people looking into. But you can certainly do this. I started my journey as a little 25-year-old making $25,000 a year, and I was able to become a homeowner. It was a lot of God and a lot of obedience, because I did wake up one morning and say I wanted to become a homeowner like in November, but it took about 3 months before I even decided to apply. And it took another 2 weeks for them to give me an answer, even though I worked for the institution I was applying for. We ain't gonna talk about that. The point is that you can absolutely become a homeowner if that's something that you want to do, but you have to plan for it, and you have to be really diligent about making sure that you stay on task. So, like I said, I recently, right before I left, I was talking to somebody who was wanting to get a home, and they wanted to also get a new car. I'm like, don't do that. If you're trying to get a home, your best bet is get a home and then get a car, because it's so much easier for you to get a car loan than it is for you to get a mortgage loan after you go and get a car. Yeah, I'm telling you, just from experience, I'm telling you, it will really mess up your chances of being able to get a home, and it can delay your ability to get a home. And then depending on the circumstances of that, you can end up paying on a car loan for a really long time, which if you don't have the same income increases as you're expecting, then that will tie your hands in the process. So trust me when I tell you that it is attainable. You can do it. Just understand that it is a process, and you have to do your due diligence, do your research, and don't be afraid. If you don't know, ask me. I do not mind, really. 8 years and 2 homes later, I really don't mind. Shoot me an inbox. I'll help you as much as I can, because I want to see people actually reaching that goal of home ownership, because that's what I was able to do, with the right people in place. So, like I said, when you are looking for a realtor, make sure that person has your best interests at heart. Make sure that they are willing to guide you through the process. And if you have to have gentle guidance, make sure that they, they're a right fit for you. Everybody doesn't work well with you, and you won't work well with everybody else. So just make sure that you get the right fit. Do some interviews with people, ask them questions, just to get an idea. Just don't get your cousin's best friend just because it's your cousin's best friend. They might not be the right fit for you. So just understand that. But I trust that you all will use your resources. You will also ask me if you have any questions, but I greatly appreciate y'all for tuning in. I was really, really ticked off about that article last week, and I said, I'm going to go talk to people, because you have to know that, you got to go into this as educated as possible. So again, I'm Yolanda G. Macumbe. I am so excited to have come to you this evening to talk to you about home ownership. Please don't hesitate to reach out to me if you need to on Facebook. You can find me on Instagram, same name, Yolanda G. Macumbe. I'm so creative, right? But I hope you all have a great Wednesday, and I'll talk to you soon.